I'd like to welcome you to the financial reporting online support from Zaptac. My name's Ngandalo Joseph, and I'll be your tutor for the financial reporting class. Again, financial reporting is one of the most important subjects in your career. I hope by now you know that it's a core area, feeds into auditing and taxation. And of course, this is our online product. If you have any questions on what I'm going to discuss today, please feel free to get back to me on that line. All right, so let us progress and try to see if we can make sense of what we have today. I want to focus on the framework for financial reporting. Framework for financial reporting. Framework for financial reporting. The learning outcome, we need to discuss and apply the key principles underpinning the conceptual framework of financial reporting. Of course, if you read your textbooks, you will find more data on what I'm going to discuss today. My hope today is that you're going to have a firm and clear view of what the framework is all about. So why have a framework? I guess that's a nice question. The IFRS framework describes the basic concepts that underlie the preparation and presentation of financial statements for external users. In fact, this particular framework deals with general purpose financial statements. A conceptual framework can be seen as a statement of generally accepted accounting principles that form the reference for the evaluation of existing practices and development of new ones. If I may read that one again, a conceptual framework can be seen as a statement of generally accepted accounting principles that form a frame of reference for the evaluation of existing practices and the developing or development of new ones. All right. It is very important also to think about fair presentation in our discussion for the framework. Fair presentation is very much emphasized in the subject of audit. Of course, practice of audit out there in the industry. Fair presentation is the term used in IS1 presentation of financial statements, equivalent to the concept of true and fair view. Fair presentation is only met when the financial statements comply with IFRS and ISs, as well as interpretations of IFRSs, which of course are formulated by the interpretation committee of the ISB. Let us move on. What is the purpose of the conceptual framework? The framework seeks to ensure that accounting standards have a consistent approach to problem solving. And of course, in the past, we have had challenges when there's need in an area of accounting. Standards were developed in an haphazard, manner just to respond to a problem, but the framework seeks to do away with that, help us to come up with consistent standards that can secure public confidence. And then the second question says, framework assists the ISB in the second statement rather says, the framework assists the ISB in the development of coherent and consistent accounting standards. The framework, by the way, is not a standard, but rather acts as a guide for the preparers of financial statements to enable them to resolve accounting issues that are not addressed directly in a standards. Are there advantages to having a framework? I think there are several. Number one, financial statements are more consistent with each other, and consistent financial statements promote reliability. Number two, framework avoids firefighting approach and has a proactive approach in determining best policy, for the formulation of accounting standards. that are coherent, that are consistent. And then lastly, if we have a framework in place, we shall be less open to criticism, political or external pressure. I hope that you can see that. Let us progress to the next one. Disadvantages of the conceptual framework. There is nothing that has got disadvantages or advantages without, the other. I'd like to start with the first one. Says a single conceptual framework cannot be devised which suits all users. Again, in different countries, we have got different purposes. For preparing financial statements, you got different users out there. It's not very easy to suit their information or needs with one conceptual framework. There is need for a variety of standards for different purposes. Of course, we agree with that, and the framework just produces one type of standard, that is principle-based standards, and we will discuss with you the differences between the two when we deal with the regulatory framework. And then next we've got the preparation and implementation of standards may still be difficult with the framework, especially where the spirit of the framework is not appreciated. Let us look at the ISB conceptual framework and just run through the major contents. We have got the purpose of financial statements, the elements of the financial statements, the recognition of the elements, the measurement of the elements of the FS, the only underlying assumption of the FS, which is going concern, the concept of capital maintenance, as well as the qualitative characteristics of financial information. Let us start with the purpose. Well, the objective of general purpose financial reporting is to provide information. Of course, we have got an array of users of general purpose financial statements. These include investors, lenders, and other creditors, and they must make informed decisions regarding their investments, regarding their dealings with the business. And so the key is emphasized here, the provision of information. The recognition of the elements, the financial statements. For an element to be recognized, there should be the following present. Number one, reliable measurement. Of course, that speaks to money measurement concept. Probable flow of economic benefits. Of course, that speaks to value. And of course, for those who are crazy about auditing, we have got evidence of existence. Evidence of existence. Again, the elements of the financial statements include the following, and of course, some of you might be aware of this. Assets simply refers to present resources controlled by an entity as a result of past events from which we expect to derive economic benefits. Liabilities are simply present obligations arising from past events whose settlement will result in the outflow of economic benefits. Income refers to the general increase in the economic benefits of a business. Of course, excludes amounts contributed by equity participants because that is capital. Expenses refers to general decrease in economic benefits. Of course, this is seen in form of the depletion of assets or the increase in liabilities, but expenses exclude contributions made to equity participants. Then equity simply means the difference between assets, total assets, and liabilities. Well, we also have to deal with the issues of measurement. Again, this is a very big topic in financial reporting, although we don't like to make, much emphasis on it, but it becomes a very big topic, especially where you don't have what we call source documents. Elements of the financial statements can be measured using the following. Number one, historical cost. We can measure the assets and liabilities at transaction value. Current cost. We can measure the assets or liabilities at the current price at which we can, buy an asset or indeed settle a liability. Then we have got realizable value, which is simply selling price less costs to sell. And then we have got the present value, which is sometimes known as value in use. So this is the discounted cash flows arising out of an element. I hope that you can see that. Of course, as we have already mentioned, the only underlying assumption of the financial statements is the going concern. Financial statements are normally prepared on the assumption that an entity is a going concern and will continue in operation for the foreseeable future. Yeah, we can also appreciate this concept of capital maintenance. Capital maintenance refers to the fact that capital must be preserved. Capital is preserved when we make profit under the financial concept, and capital is preserved when we increase our production capacity under the physical concept of capital. Well, let us also look at the qualitative characteristics of the financial statements, and I think that this is a very important part of your syllabus because most of the times you find questions coming out of there. Excuse me. Okay, so let us start with relevance. Relevance simply means information is capable of making a difference. Information is relevant if it can be seen to be important in the eyes of the user. So for information to be relevant, it should have predictive and confirmatory values or both. It should also be material. Faithful representation is also known as reliability. Information is reliable if it can be depended upon, if it presents or gives a front of economic phenomena. Information is reliable if it is complete, neutral, and error-free. Please let us remember that. Comparability refers to information being subject to analysis. Of course, information should be comparable from one period to another, that is for the same company, but also information must be comparable between two different companies which are in the same market so that users can make informed decisions. So for comparability to be made possible, there must be issues of disclosure and transparency. There must be issues of consistency. So let us remember that. Understandability refers to the ability of the user to perceive the importance of given information. Understandability depends on two things: the user's economic knowledge as well as the way information is presented. Timeliness is tied to relevance. Information must be provided on time or in time in order for it to affect economic decisions in a positive way. But of course, it shouldn't come so fast. Why? Because if information is prepared in a haste, there will be a lot of errors implicit in the same. But information is coming late, it will not be of relevance to those who need to use it. And then lastly, I've got verifiability. This speaks of auditing. Information must be capable of being verified. It should be traceable to a source document. And many different users, of course, should have consensus that information presents a true face of what is happening on the underlying records. Okay, so we end there, and I would like to ask that you send me some questions on this if we have got any. I wanted us to see if we can practice some questions from our revision kits. I know that we can do that, so let's try to have a go at that. This is the SCCA revision kits multiple choice question. Question 1 says, how does the conceptual framework define an asset? A says a resource owned. So that is not the word that we use anymore. We use the word control. B says a resource over which an entity has legal rights. Again, we don't have to have legal rights. We only need to control. Then C says a resource controlled by an entity as a result of past events and from which future economic benefits are expected to flow to the entity. That is extremely correct. What about D? A resource to which an entity has future commitment? No. Yes, as a result of past events and from which future economic benefits are expected to flow from the entity. That is very close to a liability, of course. Let us go to question 2. So the answer there, of course, is C. Which of the following would be classified as a liability? Dexter's business manufactures a product under license. In 12 months' time, the license expires, and Dexter will have to pay 50,000 for it to be renewed. That's not a liability because it relates to the future. Reckless purchased an investment 9 months ago, 120. The market value for this investment has fallen and is now valued at 90. That's an asset. You see, investments are simply, described as assets. Then C says Qatar has estimated the charge or the tax charge on its profits for the year just ended at 165,000. This is an example of a legal obligation, and so it is qualified as a liability. Tax is a liability. And so C is the answer as well there. Then D says expansion is planning to invest. Planning. So if you are planning, you're referring to something that is going to happen in the future. So we can't go for that as a liability. I'd like to go for C. Let us go for the other question. Question 3 says, which of the following would correctly describe the net realizable value of a 2-year-old asset? So net realizable value is simply selling price less cost to sell. You need to remember that falls under measurement. The original cost of the asset less 2 years depreciation. The amount that could be obtained from selling the asset less any cost to disposal. I'd like to go for B because I think under A we're dealing with historical cost, carrying amount. Then C says the cost of the equivalent new asset. This is replacement cost. And then D says the present value. This is of course value in use. You remember those measurement concepts. I'd like to go for that option there, B. 4 says the conceptual framework identifies an underlying assumption in preparing financial statements. This is, again, I think we could have discussed, this is the going concern. Business shall be expected to be in existence for the foreseeable future. 5. The conceptual framework identifies 4 enhancing qualitative characteristics of financial information. For which of these characteristics is disclosure of accounting policies particularly important? I think we are dealing with comparability there. Verifiability is falling off. Tangent, timeliness, no. Understandability, no. But I think comparability is the answer there. The 6 says, which of the following is not a purpose of the conceptual framework? 1, to assist the ISB in the preparation and review of IFRS. Then 2, this one is to assist auditors in forming an opinion. This is also 1, to assist in determining treatment of items not covered. This could also be the one, but the last one says to be authoritative where specific IFRS conflicts with the conceptual framework. We said this conceptual framework is not a standard on its own. So if an IFRS, is in contradiction with the framework, the IFRS ruling still stands. That is the way it is. So we go for the last box there. For those who are doing computer-based, of course, you have to click on the last box. Thank you. So let us try to see if you can do the rest. So I'm giving you a challenge. You can always take a snapshot of these questions. Ask me some questions. I think they're just about 2 questions. Please take a snapshot of these questions, 7 and 8, and do some works and ask me some questions on the other side. Thank you very much for listening. Hope to see you sometime soon.